Simon Wallace, you are Global Head of Real Estate Research and Strategy at DWS. Thank you for joining us on BiTV.
Thank you. It's good to be here again.
A pleasure to have you back. I wanted to talk today about DWS's recent report, Europe Real Estate Debt Strategic Outlook, which states that institutional investors could increase their capital allocations to private real estate debt. Why could real estate debt strategies become more attractive in the current market environment?
Yeah, it's a good question, and almost it says in the report that institutional investors could allocate more to real estate debt. And I think actually they are allocating more to debt. So we're actually seeing it happening in recent fundraising. I think there's quite a few reasons for this. It's not one simple reason, but let's run through a few of them. I think one, in this market environment, if you are worried about downsides, right now, the real estate debt does actually give you some protection against downside risk and the fluctuations in capital values that we've seen recently. Also, returns are higher. We've got rising interest rates, and we've certainly seen some increase in the margin as well. So whether you're lending at the senior level or at the junior level, you're seeing a higher return today as well. So that's certainly increasing the attractiveness of the sector, particularly if you're looking for a cash return as well. If you've been a core investor and you've been looking for that strong, solid cash return that real estate was offering you, and a cash return often in excess of what you were seeing from a government bond yield, real estate debt is now offering you that additionality as well from a cash perspective. And I think perhaps just last two things as well. So just thinking about relative performance against interest rates as well, you are getting some protection from further movements in the interest rate as well. So if central banks do tighten monetary policy more than expected, again, you've got perhaps that natural hedge that you get with private real estate debt. And perhaps the last point is there are just more opportunities as well. You are seeing, and you certainly saw an acceleration of this perhaps following some of the events around the banking sector in March. You're seeing more opportunities as traditional lenders are perhaps stepping away from lending into the real estate market. So for the private providers, there's opportunities to get access to product that perhaps wasn't there before.
And keeping in mind that opportunities are, let's say, scarce at the moment on Europe's real estate equity market. So I see your point. Maybe as investors turn to real estate debt, the question is therefore, which strategies or sectors could be the more interesting in that field?
Yeah, that's again, a really good question. I think this is where you start to see lots of crossover between the debt side of the market and the equity side of the market as well. And I think certainly for us, when we approach private real estate debt, it is really, really important that you do understand the fundamentals of the asset of the market, of individual sectors as well. I don't think you can go into this market just thinking of this as a sort of pure debt play. It is still a real estate play as well, particularly, as I say, if you move into the higher risk part of the market, looking at perhaps more the junior end of the capital stack. So for us, look, we do see opportunities across the capital structure, but particularly for us, where do we like right now? So we like residential. We like residential from both a junior and a senior perspective, and also logistics. Again, we've got a very similar view around both of those parts of the market from an equity perspective as well. Student, we like. You're tending to get a little higher margin on student. It tends to be counter-cyclical. It tends to be a part of the market that we think there are long-term structural drivers there, and still, particularly in continental Europe rather than the UK, some perhaps institutionalization of that sector, which again should help to minimize downside risk there as well. Finally, an area that we do like, and again, this is slightly higher up the risk curve because we are thinking about more active plays here. What we like is a managed to green strategy as well. So lending into those in that part of the market, that we think, again, there are long-term structural drivers, particularly in Europe, around a managed to green strategy. So yeah, we'd
a more value-add approach, therefore, if I understand correctly.
It is a more value-add approach, absolutely, but a value-add approach which is underpinned by solid long-term drivers as well. And that's managed to green across sectors as well. So it's not just an office play, it could be a logistics play or a residential play as well.
Okay, interesting. Real estate investors face reduced credit availability and rising credit costs amidst a growing refinancing gap. That much is clear reading the report. How do you see the risk premium attached to debt strategies evolve over the coming months?
Yeah, it's interesting. It's interesting that over the last 12 months or so, I've been surprised that you haven't seen as much movement in that risk premium in the margin that you perhaps would have expected. There was a lot of noise, a lot of volatility within, certainly around the direct side of the market. Given the banking events that we saw in the early part of the year around March time, we're getting sort of anecdotal evidence or evidence that we're seeing ourselves in the market, but there's no data points really to point to this, but we're starting to now see an increase in the margin. It's not huge. I got to say that it's not a huge increase, maybe a 25 to 50 basis point increase in the margin over the first sort of quarter, first half of this year. I think we may see that edge higher, but I don't see a major movement unless we do see some significant distress, perhaps in the financial sector or perhaps at the economic level as well. So you're worried about the fundamentals of the asset class. But as I say, we're not seeing a major jump in risk premium or in the margin at the moment. But I think what it does say if you're operating in this market at the moment, that you do need to be more thorough in your due diligence, and perhaps you need to be stricter in your lending criteria as well, thinking about LTVs, thinking about how you're these sort of assets that you're approaching right now. So yes, there's a little bit of caution as a result of that, but nonetheless, as I say, so far we haven't seen a huge jump in margins.
Okay, Simon Wallace, that's all the time we have, sadly, for today. Thank you again for sharing your insight with us on BiTV, and thank you all also for being with us. We'll see you soon on BiTV.